anybody can charge a price. So price in and of itself is not an advantage. So getting to the price shouldn't be the service or the journey or the customer experience. That's it's just, because somebody else could just say, I'll match their price. So where's the advantage in that? It's always been about something other than price. Otherwise, if it was just about price, Geico wouldn't advertise because their price would be lower without spending advertising. I'm Bill Martin from Plymouth Rock Home, and this is the future of insurance.
Hey everyone, I'm Rob Savitsky from Duck Creek Technologies, a provider of SaaS core systems for P&C insurers, and I'm the host of our new podcast series, Conversations on the Creek. In each episode, we interview our partners from across the InsurTech ecosystem about industry trends, innovative technology solutions insurers are using today, and where P&C insurers may be headed in the future. So listen and subscribe to Conversations on the Creek on Apple Podcasts, Spotify, Google Podcasts, and by visiting duckcreek.com/podcast/partner.
Bill, it's great to have you here. Thank you for joining me for a conversation for the show.
Great to be here.
So we've gotten to do a couple of conversations for different webinars. I realized I didn't talk to you when I ended up quoting you for my book. I got the quote secondhand from Jim Albert, but that's okay. But I feel like I've been kind of swirling around you for a while, and it's great to actually get to sit down and hear your thoughts directly.
Yeah, it's good to talk to you too. You've seeded a whole thought process or thought group that hasn't existed in our industry in a long time.
Well, that's what's fun. We gotta be thinking more. You've been. I was going to say you've been around a long time, but that doesn't feel like a nice thing to say. But you've been at the center of a number of some really pivotal and interesting things in the industry. You've done some really fun stuff and seen things that, if we start to look at what's happening right now and where it's heading, you've actually been in a lot of those building blocks, or the things that now feel so common or critical. Like, we've been talking about your time Progressive and the whole product management shift that went on there, that is now, the commonplace in the industry, at least in this country and several others. You're part of the founding duo at Neptune, InsurTech boom, and pushing the front on flood, which is just like the worst customer experience historically of any purchasing experience. And the shifts that you guys have made there, and building what you're building at Plymouth Rock. So it's interesting. I don't know how much you've sat and reflected on all these pieces coming together and how they really are kind of sticking together and moving the industry right now.
Oh, I think there's a lot of heroes that are unsung in the industry, but since I got involved with it, and maybe partly instigated by who I first started with, the talent level of this industry has really been raised. That's why, Brian, when I hear people talk about coming in and shaking up the old boring guys in the industry, I always kind of laugh, going, that was the industry of 50 years ago. You might be shaking up some people who will actually hit back. So
yeah, oh, absolutely. I mean, there's some really impressive cutting edge stuff going on in boring old insurance. But we all know that. We're amongst friends in this podcast and the listeners. Just share a little bit about that product management switch and what does that mean? Because it's something you lived through, and now people probably don't think twice about it. But thinking about the old school, the London, the underwriter at a syndicate kind of thing versus what we have now, and what is underwriting versus what does product management mean?
Yeah, I mean, it's I guess once something gets to be 30 or 40 years old, it's time to take a step back and say, what exactly just happened here. But the folks at Progressive back in the 80s, I joined them when they, I think, just broke 300 million in premium.
Isn't that crazy to think about?
It's hard to believe.
Yeah.
I sure wish I kept more stock. But they were making a big investment at the time in independent talent, and they had to invent a role that would be, in essence, a mini CEO role. And what they admired was just down the street in Cincinnati. It was Procter & Gamble's brand management.
Yeah.
Where somebody for a particular brand, even if it be a shade of a brand, chocolate Cheerios or whatever, would be in charge of the P&L, and they would set the standards for the entire chain. They had nobody reporting to them, which was kind of an irony there, but
Right.
they would still be accountable to and be able to have the authority to direct everything about it, from the taste to the look of the box to how the trucks delivered them and stuff like that. So they created something called product management, and I'm not sure if the word was stolen at the time or not. There's probably a lot of people in the tech world who think it was, but the tech world didn't exist back then. It was a big old compact box that weighed 40 pounds, right? That was their portable. But you know, they created this job, and then they would go to the top dozen business schools and look for talent, convincing talent to come, and it would be the CEO himself that would go. And once they saw him opine openly about what he was thinking about and ideas he had, they realized, you know what? This isn't just boring old insurance. This is a whole paradigm shift in the form of a human being who's saying you can actually grow and make money at the same time. You don't have to choose between the two. And this is at a point in time when the market was going crazy, in the sense that everybody thought that juries were out of control, so we had to get out of anything that said liability in it. And many of the big players who had sold all the auto insurance at the time left the market to Progressive. That's essentially what happened. Progressive was there when everybody bailed in the liability crisis, and they became a leader very, very quickly. By the time I left, they were at 1.2 billion, and that was only 3 years later. They quadrupled in size in 3 years.
That's crazy.
And it was because of these little fiefdom CEOs, these snobby, self-important product managers that were walking around the office telling everybody what to do. They obviously learned about managing by influence rather than authority, and became very good managers and kind of spread through the industry.
Yeah.
You shoot ahead now, 40 years or 37 years, whatever it is. And product management is actually a term now more owned by the tech world.
Yeah.
There's probably more tech product managers, and they split them up now too, in like technical product manager and marketing product manager. But if you think about it, it's the same thing. It's invent a consumer-facing product. Nobody in the insurance industry thought of insurance as a product until Progressive did, and that's what Flo's all about. She's selling it from a retail store with a box, right?
Yeah.
But and now they think of tech as a product, and it's really a service, right? And how do you make this work better for the consumer? And by figuring that out, and figuring out the pricing and the marketing and all that, you will be accountable to the profit and loss of your product.
Yeah.
So there's another element of this I'm kind of excited about myself, because I think being a product manager in our industry is harder. And that is that they're realizing in our industry that the tech product manager has some things to teach us. It is actually as important how you present to the customer and the distributor, the agent or marketer, as the product pricing and underwriting itself.
Yeah.
At some level, the invention of product management at Progressive created advances in pricing that we all now kind of live with as if it's normal today. Everybody brags about advanced analytics, but the truth is we've all got it.
Right.
You know, Progressive, it's going to be hard to beat Progressive on analytics because they have more data, but at the end of the day, that's less of a differentiator than it was 20 years ago.
Yep.
And so now the differentiator might be in brand, in position, in the process. Kind of the reason for Neptune's success. The process could actually be an advantage.
Well, I'm wondering about the process piece of it as I look at, I don't remember who, it might have been Jim. I don't remember who, when I had them on the show and talking about how many questions do you ask? And it's like everyone's trying to get to, I mean, effectively 0 question underwriting, but the 3 question rule seems to be the magic number. And that's effectively 0 question. It's like name, address, and some contact detail, phone or email or something, so we can get back to you. And then the rest is third-party data and AI and modeling. It feels like as more and more folks push to that, and in your home product, you've got this really easy quote process as well. Does that level the playing field so that the customer experience on the acquisition side, at least, is no longer a way that you can differentiate or have a material advantage? Or can you still do that even if we're all using all these other methods other than asking the customer to tell us, the answer to all these things that they don't necessarily even know the answer to.
Well, let's be clear. Anybody can charge a price. So price in and of itself is not an advantage.
Yeah.
So getting to the price shouldn't be the service or the journey or the customer experience. It's just, because somebody else could just say, I'll match their price.
Right. Yeah.
So where's the advantage in that? It's
Yeah.
always been about something other than price. Otherwise, if it was just about price, Geico wouldn't advertise because their price would be lower without spending advertising money.
Right.
So,
Yeah.
so in my world, you've always been trying to win over customers with something else, whether it be the outsourcing of the effort to get the right amount of insurance through an agent, or it be some sort of unique offering that sets you apart and attracts people to you,
Yeah.
or something like that. So yeah, let's say everybody got to the computer sees your face and quotes you a rate.
Right. Yeah.
It's kind of scary, but we're not that far from it.
Yeah. There's life insurance
So,
that's working that way.
yeah, that's right.
Yeah.
So anyway, so they said we got there. What would the customer do presented with a rate and a set of coverages and terms? They could spend a lot of time figuring out what those coverages and terms mean. So one of the big surprises for these speedy interfaces that Neptune and Plymouth Rock have introduced is it's actually become more powerful in the advised channel than it has in the direct channel, because now your agent is talking about coverage and coverage options with you and discussing what you might want to need or not need, or what's at risk if you don't buy it,
Yeah.
as opposed to talking about the price.
Yeah. Yeah.
And at some level, home insurance is always an optional coverage. Only your lien holder makes you buy it. So you are more worried about whether you're covered than whether you've saved $10. That's
Right.
probably why there's a little more inertia in my business than there is in the auto world, where all the coverage seems to be the same, right?
Right.
It isn't, by the way. It's very different companies with very different coverages, but nonetheless, by genericizing the auto insurance business, it has become about price, and unfortunately, that's not serving our agent force well, or even the people who market it in a big way. You could see direct companies quoting inadequate coverage just to get the customer.
Yep.
As a method of competition, and that's not a good way to compete, to undersell the customer.
Yeah. There's so many industries that work that way. It's like I just saw, I was at a pitch night for InsurTech Hartford, and there was a cyber distribution solution. And as you're going through the journey, it said, okay, you can get coverage from $716 a year, or some 700 and teens amount. But you need to answer these other 6 questions. And once you do, then the quote comes back, it's like $3,200. I was like, well, what was the point of that? And like, was there even a $700 option or not? I don't know. But I mean, every industry does it. Like, car companies advertise without delivery charges, even though you can't get out of them.
Well, in the tech world, the product manager is watching you and saying, oh my God, when people go down this path, I lose 99% of them. When they go down this path, I only lose 98. So I better fix this.
Right.
I better give them something that actually is 700.
Right.
And that tells you again, the interface, the presentation can be as important. We, for instance, at Plymouth Rock, present you 3 options. We won't present you one. And if you don't buy the better options, the more rich options, you kind of want to. It's kind of like seeing the next version, the next higher end version of the car you just bought, and saying, someday I'm gonna get the satellite in my car, but this year I just can't afford it. So it's kind of it's a good thing to have out there as something to covet and draw people to.
Yeah, I did just talk to someone about this as the jeweler's approach, where for anyone who's bought an engagement ring, they always show you a diamond that's bigger and nicer than the budget you just told them, because then you've set your bar higher. And so when they have one that's just a little bit more than you would have spent otherwise, you don't see how you couldn't do that, because your whole bar has been raised to this unobtainable, insane one.
I find that realtors do that as well.
Realtors, yeah, 100%.
A little nicer than you can afford.
Which means higher home insurance costs, which is more premium. So yeah, it's everyone wins. Yeah, no, there's lots of magic in sales. That's a nice way of putting it. But the product management idea, in hindsight, like, it was a shift, but in hindsight, it's brilliant. And this notion of owning more than just the evaluation of risk and building the model behind it, but how successful is that risk that you just evaluated? How successful is the business behind it? And having someone actually kind of skin in the game or feel that ownership of it is, you I would imagine it leads to a much more holistic approach to how do we solve for this market need and respond to it rather than just staying complacent.
That's right. You think a lot harder about your end customer segment if you don't have to think about everybody.
Yeah.
I think the first product I was assigned was an Arizona light commercial auto product, and had all of $5 million. And the second day I was there, a heavy pickup lost its brakes and rolled backward down a hill over a Porsche and a wealthy professional model.
Wow.
Which meant that it was a limits loss, and immediately
Yeah.
I had 10 more points on my combined ratio, and I wasn't getting a bonus next year.
Yeah.
So I had to revamp the product it had to have some scale in order to write it out, but
Yeah.
but I needed to find some segments where I didn't have that kind of exposure for the scale, and thought hard about where we could play if we couldn't play in a $500,000 liability policy.
Yeah. The tools that a product manager has at their disposal today, depending on the carrier and how much they've adopted them, but would allow for that sort of responsiveness and fine tuning at a much more minute but rapid level than we've ever had. Because that could still be an 18-month process to go through everything you need to go through and get it filed and approved. Arizona's an easier state than
Arizona
others.
at the time was a file and use for commercial, and we printed rate guides. The agents actually had to calculate out the algorithm. There was no discs. I introduced a disc product at Progressive way too early. People were pinning it on their wall like a plaque or using it as a coaster. But it was, the funny thing about this is it's also cultural. As you noted to me before, underwriter as a word, what scares people away. It sounded boring and horrible. And in Europe, it's considered a vaulted role.
Yeah. You're a rock star. If you're an underwriter at Lloyd's, you're literally like a rock star. Everyone knows who you are.
So Progressive could have called product managers underwriters, but they wouldn't have been able to recruit anybody. So they changed the name of it. It's really, they're making the same decisions, building the same books of business, and being accountable to the results. Could be future CEOs if they built the business big enough. And it was about building the business under you. It wasn't about climbing a ladder. It was about building the business under you.
Yeah. Underwriter's a line role.
Yeah.
In the US.
In the US, it's a processing role.
Right. I had to explain how the underwriting, like the world of the CUO and the underwriting process works to some folks outside the industry. And they're like, wait, but underwriters may not be part of the CUO's organization. Why isn't the CUO doing the underwriting? I'm like, because underwriting in the US is largely just that line facing role to get the risk on the books. But the people who came up with the rate and own the product and all that exist generally in the CUO's role. And it depends personal, commercial, and corporate structure, but they're not doing anything on an individual policy. They're at the portfolio level and the creation and all that. It's totally different.
Yeah, and think of the cultural importance of this, Brian. You've told somebody they can take company money and do creative, innovative things within your segment. That is a cultural build, not a specific strategy and product design.
Yeah,
it's on a whiteboard. You get to do whatever you want, right? So so people would invent something in Atlanta, and those of us out in Sacramento would say, that's really cool and that's working, I'm going to do it too.
Yeah.
Or somebody would fail and we say, oh, he learned something, I'm not going there. So it was this kind of network of innovation that is really the more important part of the culture of successful companies than the specific strategy itself. Nobody's ever going to repeat the success of Geico because it's no longer that time period.
Right.
Nobody's going to repeat the success of State Farm because it's no longer that time period.
Yeah.
So you can't build a sustainable, repeated success, but you can build a culture that invents what success means next year.
Yeah.
And that's the key to somebody in my role now, which is I got to build a culture where people can evolve success to its new meaning in a new era. It's going to be entirely different than what I invented with Neptune and Jim and 6 years ago.
Yeah. Well, so talk to me a little bit about that on the talent side as you're building that culture. What do you think is necessary skill set and people, and what's changing in the talent pool and the way that we attract it to meet these changing needs?
Well, this is to the credit of the insurtechs and others, is they recognize not having insurance experience has a value.
Yeah.
So while you might bring somebody in with insurance experience, the thing you need to test for in the interview process is whether they're thinking about it like an insurance person, or they're thinking about how to do a substantially better paradigm shift from what they learned in the industry.
Yeah.
They're two very different people.
Yeah.
And because a lot of times you'll get people from the industry who come into your business and say, I'm going to do the things that made me successful in the past that they aren't doing here. They're the best practices. And that's fine, but it only gets you to par. It doesn't get you to beat.
Yeah.
And to get to beat, you're actually going to have to do something different. Otherwise, you're trying to do something a bigger company has perfected. You're not going to beat the bigger company by doing what they do better. So we look for talent that isn't intimidated by the thought of doing a better job than the leader in the industry. So the leader in my 6 states for home insurance is Allstate. I'm not going to try and beat them across the board, but I'm absolutely going to find a segment where I'm better than them.
Yeah.
And that's what I'll focus on and attract the customers out of that segment. And better means something different to each of those customer groups. You have to design it around the segment. It's the old idea that you don't defend your market unless you're the leader. You have to, and a full frontal attack generally doesn't work. So you either got to focus on a particular area, or kind of undermine them with lower expenses and be able to offer the product at a lower price.
I mean, to me, that I totally agree with what you're saying, but I think it goes back to what Progressive did in the early 2000s when they were publishing, recent quotes people had gotten on their site. And I remember I was at Liberty at the time, and we were like, this is crazy and this is stupid. And of course, Progressive's always going to be the cheapest, because why? You would never do that otherwise. But it's not about being the cheapest. It's about being the right price for that particular risk, because you don't want all of them. You don't want to just steal everything from Allstate by underpricing it. You have to pick the right risks to compete for. And a friend of mine got a quote from Neptune that was like 8 times higher than what my house quoted for. And we're in totally different parts of the country, different homes, different, like, not saying one quote was right or wrong, but my sense is like, Neptune's really inexpensive. It's a great value. Why wouldn't you get the coverage? And he got the quote and he's like, oh my God, he's so underpriced in the coverage he has now. And it doubled. And that's why he was shopping, but it's still like a third of what Neptune quoted. And so the answer is like, well, Neptune knows something and they don't want that risk. Or if they do, they want to make sure they're getting the right premium for it. It's not just about be cheap on everything. It's about fine tuning the selection.
I think the team there, Trevor and Jim, would tell you that they get way more excited in selling coverage that the National Flood Insurance Program doesn't offer,
right,
than just beating the National Flood Insurance Program. They can beat them in places because they were built on a community rating system, which isn't risk based, but at the end of the day, they have to limit their exposure to a certain area, and their prices go up as they limit it.
Yeah.
But they also would prefer customers who appreciate the value of the coverage enough to buy more than the basics.
Yeah. One, I know Jim's talked a lot about the 62 million homes that aren't covered for flood that have exposure. I had Phil Ziedler, who's the co-founder and CEO of a term life provider out of the UK called Dead Happy. I talk about them a lot because I think it's a brilliant name. But it's a great solution. But he's not interested in the share stealing for the people who are getting life insurance now. He's looking at the gap that's in the market and what that means for, those kids whose parents die. That then, he has stats from the UK in his market that it's 112 kids are left parentless every day, or at least one of their parents die, and half of them, there's no life insurance. So you think about, almost 60 kids a day are potentially going into some kind of financial distress. that could have been avoided. So
To be in the nexus of climate change, where it's an active conversation on the top of lists, and
yeah,
we have two of the largest states in the nation, Jersey and New York, experience massive amounts of flooding from a storm that hit land
yep,
hundreds and hundreds of miles away. And for a lot of those claims, if not the majority, to be in an area that they don't require you to buy flood insurance,
right,
so an X zone, as they call it.
yeah,
It's these are all good timing. And don't fault timing. You got to be able to see the trend. State Farm not only could make it lucrative to sell insurance, but they were at a time when people were buying cars. I mean, they were
yep,
buying a lot of cars when State
yeah,
Farm got big, and they also used some segmentation. The funny thing about State Farm farmers and Allstate is they all had the same idea. Hey, let's charge rural people less.
yeah,
And that's why you got the name State Farm, or the whole state, Allstate,
right,
or farmers, right?
yeah.
So,
Nationwide, same thing.
yep, nationwide
There's a
everywhere.
lot of that. But to your point, that was the story then, and that was the right strategy. And there's a reason why, fast forward several decades and you have Geico and Progressive, and fast forward a little bit more before they really start to get to the scale that they're at. And different generation now. You can't just be a newer version of Progressive and expect to win. There's different drivers of the potential for success.
That's right, and it takes some creative thinking that isn't hampered by all the reasons people didn't do things in the past to bring you there, and an environment where they'll let that creative thinking increment and experiment
Yeah,
and enjoy it. So you need somebody that has the initiative, and you need the environment that allows them to use that initiative and make some mistakes,
yeah.
and that's a culture that's fun to build. That's what we try to build at Plymouth Rock. It's a really important element of cultural success that lasts a lot longer than strategic success.
Yeah. And Bill, I do see when I look at some of the startups, I see I'm trying to figure out like why do they exist, or what's their right to exist or right to win. And that's I don't mean that like dismissively, but that, like from a strategic standpoint, I'm trying to figure out, well, what's the secret sauce in this? Why does this get to be? And when I see ones that it's sort of predicated on like, well, we need to get big, and once we're big, then this all works out. That feels like, well, that's State Farm, it's Allstate, that's Geico, that's a lot of them that the model works at scale. But then I see others that it has nothing to do with scale. And it doesn't mean that, I mean, to your point on like that one car accident, is you can tank a small book really, really easily. So being too small is dangerous regardless of your strategy. But different space entirely. But I look at like Beam Dental, who has grown 800% in 3 years. So significant growth, more than the Progressive example that you gave, but that's super rare.
Yeah.
But it's not just that they've grown like that. They've also done it while being more profitable than the industry. Now, granted, the dental insurance industry is not profitable. So it's like we're slightly less terrible than everyone else, but actually like they are profitable. They're running loss ratios 10 points better than the industry, even though they're small and super fast growing, and all the kinds of issues that a new book would have. So they're not predicated on scale for success. I think that's really interesting. Is that something you see as well as you sort of look around and material advantage and what's in the strategy, who's going to make it?
Yes, I see it. There are Florida's home market would do much better with 150 carriers than with 20. I mean, it would be so much better. There'd be so much more capital going to it. But everybody gets ambitious and thinks they've hung the moon and wants to be 400 or 500 million. And it's like you can't be 400 or 500 million in Florida without having over the top issues and reinsurance cost issues and that sort of thing. But so there's a place for little in some segments. But I think the acid test of these insurtechs and startups is whether the founder owner has a vision for why the customer will allow him a profit at some point. If they have that vision in their head, this is why the customer is going to pay more for me and allow me a profit. Because remember, the industry is not making a profit in a lot of segments.
Right.
So in order for you to make a profit, you're probably going to have to charge them more. And so if the whole goal is to remove costs from the system, I'm betting you're not going to meet the scale players. I think you'll end up short. So what is the reason why the customer will pay you that profit margin? And if you have that in your head, then people can tolerate the spending on the build. if the only thing you're saying is that I'm going to have lots of customers, you're playing with an internet game that doesn't really apply, and that's that the eyeballs matter. You're not selling eyeballs in insurance. You're not. You don't get any credit for having the biggest book. None.
Yeah.
You have to be able to pay their claims,
Yeah.
and still walk away with a salary. And so, there's no value there's a lot of value in having fewer customers with higher premiums. There's not much value in having tons and tons of customers at a loss. So you got to look closely at the founder and the visionary, the guy who's really driving an eye, and say to that person, where is it that the tipping point proves that what you're building is of value to the customer? And what signal is it, and how does that happen? And if they really haven't been tested with the profitability problem, I'd probably hold my money back, because they haven't really got a vision. They've just got a better mousetrap that they think's that's ignoring the mathematics of the industry and bragging about ignoring it. I just was listening to a podcast this weekend from Wondery. I don't know if you heard of this podcast company. There's a narrator who runs it who's very, very good. He's excellent, Lindsey Graham. He does his own commercials, and I'm listening to this history podcast, and he says, the insurance industry is not a good one. And I should know. I spent a decade or so working in it in some manner or another. In it, I think you'll find two types: sloths and snakes. Sloths that love to obfuscate or delay with onerous administration, or snakes that will sell anything to anyone at any time. And then he ends the commercial talking about a company that sells auto and home insurance, and it's one of my agents. And I'm sitting there going, and it's got a funky InsurTech name.
Yeah.
And I'm sitting there going, I don't want any customer that responds to this ad.
Yeah.
So I called up the agency and said, hey guys, you really don't want these customers. I understand what you're trying to do, but if your brand and your business proposition is I'm not a snake, you're hurting yourself and the whole industry. Do something better that is aspirational, not negative, right? But you hear the negative sell all the time.
All the time. Yeah.
So.
That's a whole other conversation we could have. So, but then I'm like, so they're sloths? Is that what we're left with? That's okay.
I know, he just called his own advertiser a sloth, I guess. I don't know.
But we're like, there's lots of memes about us, so that's okay. It's worth buying us.
I know, it is a little entertaining at times.
Yeah. Wow. All right. Well, so Bill, we've only got a few minutes left, but I would love to just hear your thoughts on anything brewing that you think will be sort of critical for us moving forward. Like, what are some of the things that you think are important trends, or that you've got your eye on as this is going to move the industry?
Well, I'll name two of them, and they're related. So obviously on the top of my mind is kind of long-term underpricing in property insurance that just now is coming out again because the trends have inflected. That we've got some pretty heavy double-digit inflation, and that's going to make the people who are good at this be divided by the people who are just learning to be good. They might not have time to learn anymore.
Yeah.
So the related trend is really in the capital infusion to our business. We do need another $100 or $200 million of capital in the property world, and probably in the whole insurance world, $200 billion of capital in the world. Because if you spread a $40 billion disaster claim over a $1 trillion capital base, it's a bearable loss. Nothing is a capital event anymore. It's all just a bad year that gets recovered relatively quickly. But you can't attract capital unless it is spread that way.
Yeah.
So these startups are going to have some amount of rationalization coming here, and I hope it doesn't burn the fingers of the capital so that they actually leave with it, because there are people willing to deliver the product at the rate that needs to be charged in a way that's delightful to the customer. And it's never delightful to pay more, but you got to do it. So if you focus on that, you'll find the winners in the startup world, and the ones that'll be absorbed and expanded in a positive way rather than just as a save. So they're kind of related. You got the climate change and inflation trend in the business, kind of making the true performers and separating them from the not so true performers. And then you have the capital rationalization. We really want to keep that capital, and we really want to begin to reward it. And and the capital providers out there, the hedge funds, the investment foundations. I hear that a lot of universities are looking somewhere to put their money. We can put very small portions of their investment portfolio at risk in return for great amounts of income in the meantime.
Yeah.
And not be somewhat irrational just buying eyeballs.
Yeah. I appreciate that. I think it's contrarian to some of the rhetoric, certainly in the earlier, maybe 20 teens, about, well, you know, we need a big capital shock. There's too much capital. We need these big, you know, 100 billion plus losses for the pricing to get to. It was always about, we need to shock the industry to price correctly. But you're talking about changing that whole dynamic. So it's not these up and down kind of extremes where like we forget the lesson, and so it's pricing's too soft and we need a shock to get us back to hard pricing, which we're going to forget again, and we need another shock. You're talking about changing the way it works as an underlying dynamic.
And that's Brian, the 50, 60-year-old cycle. It's hard to be a product manager today because pricing is more sophisticated, technology is more sophisticated, you have much more compliance issues, and it's difficult for you to just tell somebody what to do anymore.
Right.
But that doesn't mean you have an excuse for your investors. Anybody who's reporting an underlying combined ratio and ignoring catastrophes should have their hands slapped and say, are you going to pay me the catastrophe money as a profit? Because I'm pretty sure you've already spent that money.
Right.
You need to include this in your mathematics and your volatility and reward me for taking that roller coaster ride, rather than just explain away, hey, I'm really doing a good job if it weren't for that 100-year storm.
Yeah.
Well, the 100-year storm is happening annually, if not more often. So let's give the people who are putting their money at risk a little bit of profit for doing it.
Yeah, the whole segmenting out the non-cat results. What is the point of that anymore?
I don't know. We do like to talk about it, though, and, you know, the companies like mine that are doing some of these things technology-wise and Neptune and so forth, you know, hey, if that guy who's losing 20% a year is worth that amount of money, imagine how much we are worth when we're making 10 or 20 points a year.
If only it worked that way right now.
Much bigger multiple for me than they do for.
Oh, my goodness.
I can only pray.
Yeah.
Right.
There's a lot of industries where that's happening. But hopefully there's a shift. Bill, this is a blast. I think it's super interesting. We'll have to do like a 3-hour conversation one time, and we'll still probably run out of time.
At least we won't bore ourselves, right?
Yeah, no, this is great. We should live stream it. That's what we should do.
There we go.
This is excellent. Thank you so much for joining me.
Great to talk to you, Brian.
Sometimes you just need to talk about a lot of stuff going on, and this was one of those conversations. And I was serious. I think Bill and I could have done several more hours of it. It's just interesting. And we actually had already talked for like 25 minutes before we started the episode. There's a ton going on, and he's been at the crux of a lot of those moments in the past and how they're all coming together now. So I think I know Bill is a fascinating guy to talk to about this stuff. And I love his opinions on it and his views, because it's grounded in a lot of those building blocks, because he's been at the center of it. It's a very cool conversation. I hope it was interesting for everybody. Thank you to Bill and to the team at Plymouth Rock for giving him up for a little bit of time for the show. Thank you to all of you for tuning in and listening to yet another conversation. I hope this stuff is fascinating and interesting and useful for everybody. To Duck Creek for sponsoring this episode. I will see you all next time for another episode. If this is interesting to you, subscribe. If you haven't already, like the show and rate and review it. Again, if you haven't, if you have and you want to up your rating, if you didn't give it 5 stars, maybe we've earned the 5 stars now, but I hope you're all enjoying it. Tell someone you care about in this industry about the show. I think the more we have these conversations, the more we're thinking about this stuff together, thinking about where things are heading, challenging each other, the better for all of us. So share the show with people who care about. And of course, you can always pick up the books that, Bill was mentioning. Neptune, Bill and Neptune's story is in The Future of Insurance Volume 2. You got 8 startup insurers there. You get 7 legacy insurers in the first book, volume 1. You can pick those up and find out more about the show and share it with people at feature-of-insurance.com. Thank you so much for joining me, and I will see you all next time, or you will see me and hear me next time with another great guest for another great conversation on the future of insurance.